TG Stocks.
Disclaimer. Any content on TG Stocks should not be relied upon as professional advice or construed as providing recommendations of any kind. It is your responsibility to confirm and decide which trades to enter. Trade only with risk capital, but if you are on the downside, it will not significantly impact your lifestyle and your ability to meet your financial obligations. Any information, technical and fundamental analysis shared and discussed should not be considered as an offer or enticement to buy, sell or trade. They are shown for illustration, training and education purposes only. TG Stocks is not responsible for any loss or damage, howsoever occasioned and whomsoever caused, which arises out of, or in connection with any losses incurred in your trading. Restrictions. You shall not reproduce, copy, reformat, publish, distribute, upload, post, transmit, transfer in any manner, or sell any of the materials without the consent of TG Stocks.
Today here in TG Stocks we will be discussing about moving averages and how to use it as one of the technical analysis tools you can use in your stock market trading. Moving average is used to identify the trend direction and price movement of securities. It helps smooth out price action by filtering out the noise from random price fluctuation.
Simple moving average is a technical indicator or tool that tracks a security's price over a time period and plots it on a line. This essentially smooths out price fluctuations to give an investor a general idea where the trend is heading. Using simple moving averages to determine trends, an investor can better identify buy and sell signals. To create a simple moving average chart, start by choosing a time frame. A time frame can be any period of time, including a day, a week, or even a month. For this example, we'll define a period as a day. Let's create a moving average using a 20-day chart. We'll take each day's price and add them together. Then we'll divide that number by our time frame number, which in this case is 20. This gives us today's 20-day average price, which is a short-term moving time frame and one that active traders may use. To create a moving average, each day will drop the last day in the time frame and add today's. A 20-day moving average can help determine short-term uptrends, downtrends, and sideways trends. Examining a security's moving average in relation to its current price can help investors identify potential buy signals. For example, when a price breaks above an upwardly sloping moving average, this could mean it's a good time to buy a stock. Another buy signal could be a support bounce. This is when the security's moving average acts as a support level for the price. When the price comes down to the moving average and then rallies up again, this bounce could be used as a buy signal. On the flip side, moving averages can also help investors know when to sell a position. For example, if the stock's price rises to the moving average and bounces, this might be a sell signal. Looking at a simple moving average over a short-term time frame can be very helpful, but it has its drawbacks. One thing to be aware of is whipsaws. A whipsaw is when the stock crosses over the moving average, giving one signal, and then reverses quickly, giving the opposite signal. A short-term time frame like 20 days usually shows more whipsaws, which is why some investors may prefer to use intermediate and long-term time frames. For example, intermediate-term charts with a 50-day moving average show a smoother average and have fewer buy and sell signals. As a result, the investor may stay in the trade longer. Long-term trends like those found with a 200-day moving average are even smoother. When looking at all these averages together, we can see that the short-term average is confirmed by the intermediate and long-term averages. The main disadvantage of any simple moving average is that they're slow to reflect price changes. Because each period is given equal weight, day 50 counts as much as day 1. As you can see, a large gain or drop hardly factors into a moving average for some time. This is known as lag. Let's look at an example to illustrate this. If you use a simple moving average for buy and sell signals, your stock could experience a huge pullback well before the simple average reflects this activity. To avoid lag, consider using another analysis, such as a weighted moving average or exponential moving average. These types of moving averages consider recent data the most relevant and give it more weight. Consequently, these types of moving average lines react quickly to the security's price changes. This is helpful for active traders who want to place short-term trades. It's also important to note that moving averages don't predict future performance. They only confirm established trends. Even with these drawbacks, moving averages are a powerful tool of technical analysis that can help you determine trends and identify buy and sell signals.
Moving averages are used to identify trends and confirm reversals. When the price is above the moving average line, we consider the instrument to be in an uptrend. Conversely, if the price is below the moving average line, we consider it to be in a downtrend. The breaking of the moving average line usually implies a trend reversal. Moving averages are also used to identify areas of support and resistance. Many traders will consider the moving average line as a support and resistance level indicator and base trades on it. So traders will check to see whether the price is going towards the moving average and see whether it will bounce back from it or break it, as with regular support and resistance level. Oftentimes, the price of an instrument will find support at the moving average line when the trend is up, and will find resistance at the moving average line when the trend is down. So moving averages will tell you whether an instrument is trending up, down, or if it's ranging. It can tell you if a trend is still in motion and whether it is reversing or losing momentum. Have in mind that a moving average is based on past prices and is known as a lagging indicator. Therefore, it will not warn you in advance, but it will confirm when a trend change has taken place. At the most basic level, when the price crosses up and over the moving average, traders take this as a signal to buy. When it crosses down under the moving average line, they consider it a signal to sell. Let's take a look at the types of moving averages. There are three main types: simple, weighted, and exponential. We will discuss the simple moving average, or SMA, first and show you how it's calculated so that you can adjust it according to the given market circumstance. So if you wanted to plot a 10-day simple moving average, you would add the closing prices of the last 10 days and divide by 10. This calculation gives equal weight to each day. It's called a moving average as the oldest price is dropped each time a new period becomes available, in this way ensuring that the average is based only on the last X number of periods, in our example for the last 10 days. Have in mind that the longer the simple moving average period, the more it lags and the slower it is to react to the most recent price movement. And this brings us to its downside. As equal weight is given to all periods considered in the calculation, the simple moving average is slower to respond to rapid price changes that might prove to be important. So how can you counter this? With another type of moving average, either a weighted or an exponential moving average. The weighted and exponential moving averages are calculated differently from one another, but both types give more weight to recent periods and thus more emphasis on what traders are doing at the moment. So as a result, weighted and exponential moving averages respond faster to price action by distributing more weight to recent periods and less to older periods. They reflect a quicker shift in sentiment, which can be due to changes in supply and demand or important news events that impact the traded instrument. To illustrate what we mean, if you were to plot an exponential moving average and a simple moving average on a chart, you will see that the exponential moving average is closer to the current price than the simple moving average. Apart from the type of moving average, you also have to decide on the time period. This will largely depend on the type of trend you are analyzing. Here are some guidelines for commonly used time periods: 10 to 20 for short-term trends, 50 for mid-term, and 200 for long-term trends are typically used. When and how should you use moving averages? Deciding which moving average to use and the time period will depend largely on your objective. Use exponential moving averages for shorter time frames, or if you're analyzing a fast-moving market, as you'd have more emphasis on the latest prices. Use simple moving averages if you are planning on holding a position for a longer period of time, as the exponential moving average might be too sensitive and give false signals. You should also use simple moving averages if you'd just like to filter out the noise from random price fluctuations to determine the overall market direction.
This is an example of how to activate the Moving Average Indicator tool from your Investogram. Siege Moving Average from the Indicators tab and click onto it. You can then go out and proceed to edit the days you require for your moving average to display on your chart. You can add another moving average with a longer days average according to your requirement. As seen in the screen, this is the example how moving average appears and converging paths crosses, indicating a signal to buy or to sell. Advanced use of this moving average will be given on the live charting sessions that will be done on the future.
Thank you for watching this tutorial on moving averages. Our next video will focus on how to trade using moving averages.